to the Capital Discussions Roundtable. This is Tom Nunnermaker with our guest, Amy Meissner. Today's August 5th, 2015. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, that this is for educational purposes, welcome, Amy. It's good to have you back. Actually, before I stop sharing my screen, let me go back to my desktop. Let me know when you can see the screen again.
I can see it.
Okay, so for those people who don't know who Amy is, Amy and I go back a long way to the Sheridan mentoring community, and Amy is one of our experts in Trades the Weirdo strategy, which another mutual friend of ours, Dan Harvey, created. Now, Amy's had this Weirdo alert service since I think he started in February, and you can see the results here. I've had a bit of a problem because on the trade performance, there's some other measurements that I use that measure wins versus losses, but you haven't had any losses yet, so it's just been a straight growth in your equity chart. So as you can see, Amy's been doing a great job with her Weirdo trades and up a nice profit already this year. So well done, Amy. I really appreciate all the work you do in keeping your subscribers updated.
I enjoy doing it, so thanks very much. And I hope to keep those extra numbers on the trade performance summary missing for another 6 months or so, hopefully. So that would be nice. But
happy to keep them off there for you. So.
All right. So I'll keep trying. As long as the market behaves.
Amy's going to talk to us today about the pitfalls of complacency, and I guess we'd like to make it kind of an interactive thing too. So if other people want to join in the conversation, let us know and I can promote you. But I'll do that while we're talking. But Amy, do you want to get started, or maybe a little bit more about yourself for people who don't know you?
Sure. No, I'll get started. For those who don't know, I think you get a pretty good introduction, and I guess if anybody wants to know a little bit more about me, you can always go to the. Thanks, Rick. I really appreciate it. That's really nice of you. Rick saying that Amy is the best communicator I have experienced from any advisor. So that's quite a nice compliment. I appreciate that. And I enjoy having you as one of my subscribers. You're awesome. So, but if anybody wants to learn more, I think, are you still sharing your screen, Tom?
I'm not. I can, though.
Okay. Well, if you're sharing, you can just show like whatever link you have there to check out the classes. I'm not on that website right now.
Yeah, that would be on the public site. There's a link for all of our experts.
Right, and I think even on the members site, there's some kind of link that you have to the classes or whatever. But if you click on either one of those links, either in the public, education, or on the I think on the members site, there's also a list of classes. And if you're not a member of the class or subscriber to a class, I think you have a link to those as well. If you're already logged in,
I'm
not sure.
Yeah, that's correct, but since I have access to it, I wouldn't be showing that. So this is actually the page. So this has all your track record and all that kind of stuff. So
yeah,
this is where it is.
Up to date and explains a little bit more about me. So I'll just jump into the presentation or what we're going to talk about today. And if you guys want to learn more about me or what I'm doing, then feel free to click on that and check it out. So. So today, I just thought I would talk to Tom about, what would be a good subject for a roundtable. And I thought, in this market, for the last couple years, we've really had, a lot of upside momentum and a lot of low volatility kind of environment. There's been some spikes along the way, but for the most part, there's been a lot of fill and a lot of choppiness, but not a lot of volatility, or at least the volatility that has been coming up has been very short-lived. So I thought what would be a good subject would be, the complacency that people and traders like us tend to possibly get in a market like this, and what the pitfalls might be of being complacent in this type of market, or even of just trading a certain type of market for a while. So that's what the subject is. I don't have any PowerPoints. It's not like a PowerPoint presentation or anything like that. I'm just going to talk about a number of different things, and Tom has a couple of examples and stuff, so or some things to say. So I'll just start with my little bullet point list of things that I think are pitfalls of complacency. So one of those things, as you go along and you're trading something, whether it's new or you've been trading the same type of trades for a while, but if it's in the same type of environment and things are going along smoothly, one of the things that that first comes to mind that people tend to do, and all of these things are human nature, that when an adjustment, let's say you have a certain type of trade, I'm trading the weird or for my subscribers, there's certain types of basic rules for that trade to keep it out of trouble. It's not like, every single time this happens, you have to do this. There's definitely a lot of trader's choice in there, but being experienced with it for a while, I know that, there's certain types of adjustments that need to be done on that particular trade, as well as other trades that I do, in a timely manner. And one of the things that tends to happen when people get complacent is they tend to wait on adjustments. You know what? Last time the market did this, it came right back the next day. And that's been pretty true a lot of the time, what's been going on for the last couple of years. But there's no crystal ball. There's no, or at least for me, I'm not a chartist. I'm not a technician. I, try to kind of keep up on what's going on in the market and in the world in general. Get familiar with the indices or stocks that you trade. So that definitely helps, because you do get a feel for how certain things move and how they move in certain environments. But one of the biggest things that happens is people tend to, skip those adjustments, or they wait too long and say, you know what, I think it's going to do this, so I'm not even going to do that adjustment right here. And then all of a sudden, the market changes, and it's not like it was last time or the last couple of years even. All of a sudden, there's a continued move, and it's bigger, and volatility pops up, that kind of thing. And so all of a sudden, trying to put on that same adjustment or same type of adjustment later on in the trade where it's really hurting you, it doesn't really do anything anymore. And now it's like, well, now what do? I put myself in a position where maybe I can't fix the trade, or I'm in a position even worse of where I'm hoping that the market turns around, and that's not really a strategy, right? So you don't want to put yourself in a position where hope is the only thing you've got left other than taking off the whole trade. So so I think that's kind of an important thing to remember is that, continue to do the adjustments as you normally would, because if you wait too long and the market changes from the way it is now, it might be too late to do an adjustment like that, or you might have to come up with something else, and it might not be as productive. It might not do as much for the trade for you as you were hoping. So, for instance, I don't have any specific examples to show you because the market has been so choppy. But I'll just go into OptionNet Explorer. I mean, if you just look around, let's just take as an example.
Amy, you need to share your screen.
I'm probably not sharing my screen, am I? Okay, thanks for reminding me. Let's see. How do I? Oh, here we go. Share my desktop. All righty. So if you guys can see my screen.
Yep, we see it.
Okay, you got it? Okay, cool. Just want to make sure. So, like I said, I don't have a specific example, but, you can just kind of tell. For instance, let's just look at the price chart, see where there was like a big extended down move that kept going. Well, here we go. So let's start here. So June 23rd was the high, and then it had a continued down move for quite a few days. So let's go back to June 23rd. And as you can see here, we're at 1295, basically the high of the rut and the current environment. And let's just go out a little bit to, doesn't matter, the August or the July. I guess we could look at either one. But let's say you wanted to protect, you know, you have credit spreads in the puts, and you want to protect them. And one of the ways you can protect them is by doing a debit spread in the puts, or just buying a put, or doing a debit spread on the weeklies, you know, or maybe even doing a calendar in the puts. But let's just take a debit spread, for example. So let's say, you know, you're here at the 1295 area, and you're all, you know, you're up here and you're trying to protect something. I'm not going to put in a whole trade, just kind of give you an idea here. But let's say we move to Wednesday, and the market's down, as you can see here, 10 points. Maybe it's a little early to do adjustment. Maybe it's hit your adjustment point, right? And you say, you know what, I really want to see, you know, I want to put on some protection here. So you put on a, let's say, 20-point debit spread, 10-point debit spread, or, you know, so you don't have to pay just, you know, for this really expensive put. You're using a debit spread, and then you know, in this case, you got 20 points. So you know that at expiration, which is probably not when, I mean, I don't take my trades at expiration. I don't know all the other types of trades that you guys are doing, but I generally don't take mine into expiration. But let's just, you know that by expiration, or the maximum amount that this particular credit spread can, or debit spread, excuse me, can give you is 20 points, right? But it's going to cost you something at first. So in this case, it's costing $6.10. So you know you've got about $14 left of what you can make in that trade. You know, assuming that the market, you know, the RET goes to this short strike at the 1250 or lower, right, towards expiration. So right now it's costing me $6.10, but maybe I decide I don't want to put that on right now. I know it's just going to, you know, we had a big down move. It's probably going to reverse tomorrow. So you decide not to put it on, and you decide, you know, to wait. Let's go to the end of the day, and a couple days. And, you know, all of a sudden, where'd my little guy go? Oops, there he is. I know there's a bigger down day in here somewhere. There we go. So then you got this big, giant down move, 33 points, right? And you didn't put your spread on. Well, now it's costing you $9.35 to put it on. So whereas you could have had, you know, obviously a little bit of bang for your buck there, now it's going to cost you a lot more, and it's not going to do as much, because before you had, you know, out of a possible 20 points, you had about 14 left to make on this put debit spread, and now you've only got 11. So, you know, things like that can hurt, especially if now, you know, depending on what the trade looks like, you might be in a position where it's not fixable, or it's only fixable to try to make it to break even, or your T+0 line is so slanted that the only way out of this mess is to either, you know, take a loss, or, you know, fix the trade and neutralize it. But in order to do that, now it's going to put you underwater even if the trade comes back. So you're kind of in a, you know, I'm hoping for the market to move back up in order for this to be a profitable trade, that kind of thing. So things like that are, you know, easily, I'm sure we've all been there before and done those before. So that's just like one thing as far as a pitfall that I see a lot of people thinking about, if not doing, when you get too complacent. It's just not making adjustments in a timely manner, whether they're in the up, you know, it could be an up market or down market. So that's one thing. I don't know if, Tom, you want to chime in on anything, any of your experiences with that?
Well, you had you were telling me when you were just getting started with that auto trade thing. That was a good story.
I'm sorry. Oh, right. That was, I forgot about that. So I guess it wouldn't be an adjustment, but I thought I had.
Well, certainly waiting too long to do something. Yeah.
Right. I guess waiting too long. I was talking to Tom yesterday, and I was telling him about a story about when I first started trading. Well, I kind of dabbled in it in the mid-'90s, but when I first got back into it in 2005, I really didn't feel comfortable I didn't know enough about all these different strategies to trade by myself. So I thought, I'm just going to jump back in by letting a company, trade for me, sending my brokerage directly what's going to be traded. And I chose the Iron Condor as what I wanted to learn. So, they would send out the alerts or whatever, and it would go straight to my brokerage, and then they would, automatically fill the orders and so forth, putting them on, making any adjustments, and taking them off. And so, in that way I can kind of watch and see what was going on and get familiar, and that was the way I kind of got back into it. And everything was going along great for, I think, about 6 months or so, 4, 5, 6 months, making money every month. Everything was looking good. And then it got down to, and I was doing, I think in the SPX is where I was doing the Iron Condors. And then it got down to this one trade where it was, getting really close to expiration. We're in the last couple days or whatever. And, it was getting closer and closer. I think it was on the upside. It's getting closer and closer to my short strike. And then finally it got to the point where it was the day before expiration, so the last day that you could actually possibly trade. And it was, I can't remember exactly how close it was, but it was like 10, 14 points. It was somewhere between 10 and 15 points away from the short. And it was, but it was, I could have bought them back for like a nickel or a dime or something. And I already made a lot of money on them. So I thought, well, why are they not putting in an order to close these out? Why are they, just, leaving them there? I don't feel comfortable. So I actually called and I talked to, the main guy that was there and spoke for a while. And, he just convinced me that, hey, the market's been, I've been trading this for a long time. We've never had a gap up of that much on a settlement. It should be fine. They'll settle, they'll expire worthless. You'll just, you'll get that extra 10 cents. It was like an extra, I don't know what it was. It was an extra few $100 or something like that. And I just kept saying, I don't know, you think it's a good idea? Yeah, don't worry about it, don't worry about it. Never happens. Again, complacency, right? Sure enough, the next day, market opens up, gap up a huge amount. It's hit my shorts. And then I don't know if I'm sure everybody knows this. Actually, you guys are all pretty experienced traders. But the settlement value isn't necessarily what you see as the first print when the market opens up in the morning. It's what happens when all of the stocks within that index have an opening trade. And some of them don't, it might take 15 minutes or a half an hour, or maybe one of them doesn't trade for an hour. So they have to wait for all those opening trades for all the stocks within that index to have an opening value that actually has like the first trade to calculate that settlement value. So what you see as the opening price when the market first opens up might not be the same as the settlement value. Most of the time it's very close. In this case, I got hit twice. Not only was the gap up so large that it actually hit my shorts and went above it a little bit, then on top of that, to add insult to injury, the settlement price was more than normally different and higher than than what it looked like when it first opened as well. So I got hit again. And of course, at that point, I couldn't do anything about it. I mean, that's a bad position to be in. You don't want to be in a position where you can't actually do anything about it. I can't trade my way out of that. I can't roll it. I can't adjust it. I can't do anything. I'm just kind of at the mercy of whatever happens in the morning. And I ended up, although I had made nice profit throughout the first 5 or 6 months that I was doing that with them, or 5 months, and this was the 6th month, I think, it pretty much wiped out all and some, so I didn't lose all my original capital, but I lost all the profits that I made with them for the time that I was trading with them, or they were trading for me, I should say, and then some, a little bit extra. So it was a good lesson to learn as far as, expiration and as far as being very complacent. So that was my story that I was telling Tom about. So hopefully that hasn't happened to everybody, but, it can. So that's certainly something to be aware of. So I guess that's another lesson is, well, it's one of the things that I've learned of why and this is just me personally, I never like to leave any short on to expiration because there's nothing you can do about it. I don't like being in a position where I can't actually trade. I can't do anything. So I'm kind of at the mercy. And no matter how far away it is, I tend to just take them off. I just don't even care, especially on a downside, because you never know. What if it was a 9/11 event? I mean, God forbid, but what if there was another one of those and then all of a sudden the market was closed and it was closed for a week and then when it finally opened up, it gapped down like a huge amount. So you really never know. So to me, I mean, you're probably safer on a gap up than a gap down, but that was still a little too close even for a gap up, and it was a good lesson learned. So complacency can be a killer sometimes. So that's,
there was also that Dan Sheridan told about the pits back in '87. Now,
yeah.
Evan Rothschild gave a nice presentation at Options Tribe yesterday and showed, I guess it was '87, the Dow was down like 22.6% in a day, just gapped down. And the story goes that there was a market maker who was getting ready to retire, and he made his living just selling naked puts, and he was a genius at it. He just sold puts, they'd expire, he made all this money, and he was getting ready to retire. He was on his last trade. He had all these thousands of puts that were going out for about a dime, and people were like, just buy him back and, call it a day. He said, no, I'm just going to let him expire, and then I'll retire. Well, that's when the crash hit, and those puts exploded in value. And I think he lost, over $1 million. But Dan said he had to delay his retirement a few years to trade his way back so he could be out of the hole. So yeah, those puts can really explode on you.
Yeah, that's got to hurt. Not a good feeling. So hopefully you guys out there haven't experienced anything that dramatic, but it does happen. I'm just going to answer, let me just look real quick here if there's any, Kevin Shea is saying he lost like 17 million. Ah, God, hopefully he had a lot more than that, but yeesh.
No.
Bhaskar Kaduri, I'm not sure if I'm pronouncing that right. I apologize if I butchered your name. Experienced traders say it is difficult to make money in Jeep at this present market. What is your view? The Jeep is another version of the weird or. It's not traded the same way as I trade my weird or. Excuse me. I'm not as familiar with the adjustment style in that, so it might not be great in this market. I don't know because I don't trade that version of it. In my version of the weird or, as you saw, I guess, from what Tom had posted earlier. Whoops, sorry, I'm looking for tire stores. Let's see here. We go, capital discussions. Under this sales page or whatever they have. So you can see like from November 13 is when I've got a bunch of postings here. So you can see it's pretty, I haven't had a problem with my version of it, I guess. I do like the Jeep name, but I can't steal it, so I have to stick with the weird or. But anyway, yeah, I think it does really well. I think it's just maybe the Jeep is traded a little bit different in style, but maybe it's making money too, I don't know. So Tom, do you trade the Jeep still, or does Jim? I'm really not as familiar with it.
Yeah, I trade more weird ors and broken wing butterflies. I do like your version, though, with the teenies, or as Mark Sebastian calls them, units, just in case there is a big move down. Like, Evan said, if we had a 20% move on the SPX, it would be down 400 points. Well, you can't do anything about that if it opens down that much. So having those a couple extra long puts are your best friend. Right.
Especially, and they actually help you when the volatility pops, because the volatility pops on them too. So it kind of takes the sting out quite a bit, which is a good thing. Kevin is asking me, what is your average days in the trade? Usually under 30. I think there's actually, let's see, isn't there something like that on the?
I think it shows it trade on that.
I think let's just take a quick peek in the trade history here. Oops, get that out of the way. Where is it? Oh, here we go. Yeah, it's definitely under 30. Or 30. I think 32 is the longest one. But because of what I tend to do is I put them on sometime between like 40 and 50 days to expiration. But my target exit date is always 14 days before expiration, always like the 2 weeks before. So that is, it tends to be under 30 days. So here you can see, I don't know if I didn't add that up, but I'm not sure what that average is, but definitely under 30 days. Let's see. Bob is saying, Amy, I'm close to closing my September nested high prob Condor trade, 1 put tranche left for my 9th straight winning trade this month. Awesome, Bob. I'm actually finally going to be putting together a workshop for that, the nested Condor. Bob was a student of mine in a previous class I did on the nested Condor, and has had phenomenal results with it and is doing really well, and we keep in touch. Sorry about that, with my dog grunting over here in the background. So that's awesome. Good for you, Bob. Okay, so let's go on to the next little item that I was going to talk about. Another thing that people tend to do, I don't need to see that. I don't need to share my, well, I guess I can share my desktop. Hopefully I'm still on. I didn't accidentally leave the conference. Another thing people tend to do is, stop sharing there, is tend to want to increase the trading size too much at once. So you get kind of, whether it's a new trade or an old trade that you've been doing and you've had it for a while, and it's like, my God, I've been trading this thing for 6 months or 8 months, and every time it wins, it's super easy. This is a piece of cake. I'm going to increase my size. I mean, I have all this extra margin out here. Why not use it all, or something? That's also, it's not necessarily a good. It actually can't be. It can be an okay thing. It just really depends on your experience, your account size, and if you're willing to take the type of loss that might incur on that first month that would be normal for that trade. But one thing to note is if you're going along and you're trading something that you're just learning, let's say, so you're just doing like for the weird, or I have these tranches, so 1 unit is made up of 1 tranche. And let's say you're just trading 1 or 2 tranches or 3 tranches, because even though you have the margin, it's a new trade. You're getting used to it, or whatever the new one is, whatever the trade is. And you're going along and and everything's running smoothly. Now you really want to increase. One thing that you got to watch out for is increasing too much all at once. So maybe you're easily capable of doing this, but let's say you want to go from 1 tranche to 20. That's a pretty big jump. So you're going along and you're making money on a single tranche, which is average I think is about $700-800 a thousand. Sometimes you make 1,100. Another one's 600 or 700. Another one's 800. Whatever kind of averages out, and you're used to that. Well, a loss on that type of trade is going to be should be maximum about the same amount or less. It actually should be less, but you shouldn't go over that. So if you do have a loss, which of course, I mean, these are high probability trades, but there are losers occasionally. And when you are, it doesn't hurt that much because you're trading the same amount. Okay, let's say I make an average of $1,000 for 10 months. That's $10,000, and all of a sudden I have a losing trade, and then my losing trade is $1,000, or maybe it's only $500. Well, big deals. I made $10,000. I lost, 500 to 1,000 or whatever. I'm still up quite a bit, right? So I'm just going to, increase my size. Well, what if you went from 1 to 20 tranches? And that first one happens to be a regular-sized loser. It's not a big loser. It's just a regular loser. But, it's 20 times the amount of what you had expected before. So all of a sudden that, just happens to be that first month that you do that happens to be a losing trade. It loses the same amount as it would if it was a single tranche percentage-wise, but it really hurts your account because all of a sudden all of those profits are wiped out in one fell swoop because you went up too far too fast. So that's something that tends to happen with complacency. And unfortunately, because of that, you might have some psychological effect about maybe I don't want to trade this anymore, because it hurts so bad, right? Even though you were trading it correctly for all of the months, even this losing month, but that one big loss because of the increase in size, even though percentage-wise it was normal, really feels much worse, right? So that might make you not want to trade that anymore. So that's, a pitfall of doing it too fast. Maybe, you can increase it, maybe go from, maybe trading 1, go to 2, or trading 1, maybe go to 3 or 4 or something like that. But don't go, from 1 to like 5 or 1 to 10 or 1 to 20 or something like that. Take a little time. Unless, of course, I mean, you don't mind. You have like a ton of money in the account. You know how to trade. You're expecting like a big loss, and you don't care. I mean, but as long as you have that mindset going into it, it can be okay. But just be aware of it. So that's another typical issue that comes up is with complacency. Another thing is using your margin efficiently. And actually, this bullet point actually kind of goes more along with that story that I told you about. Waiting for that last 5 or 10 cents, with having all that risk out there. So that actually, that story that I told earlier kind of goes along with this. What I'm talking about is, you want to use your margin efficiently. When you're in the middle of the trade or before starting, whether you're in the middle of a trade or whether it's, before you're starting a new one, you don't want to risk a huge amount just to make a little bit more. So if you're in the middle of a trade and you've made most of your money, but you can make a little, more, that's great. You can make more, but don't risk, don't overly risk trying to make a few extra dollars and, put yourself in a position of actually maybe becoming a losing trade or taking back a lot of the profit that you already made in the trade, that kind of thing. So you got to be real careful. I think Dan Sheridan used to call it tightening the noose. You definitely want to, keep most of the profit that you've already got in the trade and don't do anything too, stupid as far as stupid for lack of a better word, as far as, you don't want to risk. In other words, when you're getting into a trade, which is when you have the most, flexibility of, do I like this trade? I mean, that's a good way of looking at it. You look at a trade and you see it and all the parameters make sense. It makes, the risk reward makes sense. It looks good. Everything's good. You launch the trade, right? Well, towards the end of the trade, what, would you still want to be in it at that point? Would you still put on that trade? So it tends, when you're first getting into a trade, you tend to really take the time to look and see, is this a trade that I really want to be involved in before putting on? But a lot of times what happens once the trade is progressing, all of that knowledge and foresight kind of goes out the window because you're trying to make that last few $100s or whatever on the trade. But percentage-wise, compared to the risk that you still have on, it really doesn't make sense. Better to take it off and have that money available for another opportunity, whether it's in the same type of trade, another trade that you can put on, or maybe you just want to take a vacation, give yourself a little break for a few days or a week or something like that before the next opportunity arises, so or the next cycle presents itself. So that's something, just you remember what you feel like when you're at the beginning of a trade. You always have a choice before starting it. You don't have to force it. When you're beginning a trade, don't force it towards the end as well. So that's kind of another thing. And I think that kind of goes along with that story that I told at first about, the people that were creating sparring contracts for me. And, we're just saying, don't worry, we're going to get that extra 5 or 10 cents for you. But, 5 or 10 cents, think about all that risk that I had on just to get that extra 5 or 10 cents when I had already made most of the money. It just didn't make any sense. I would have never put that trade on that day. I wouldn't have started the trade on that day. I would have looked at it and go, oh my God, the risk reward is really horrible. Why would I start it? So why would I stay in it? So that's, obviously an important lesson. I'm sure you guys know. I mean, I'm sure a lot of this stuff is things that you guys know, but I just thought it was, it's kind of just an important subject right now because the market has been so low volatility for such a long time. So sometimes it's good to remind ourselves of things that even though we know in the back of our head, we tend to drift towards being complacent again, and you got to kind of kick yourself and say, hey, don't forget these rules. They're there for, they're there for a good reason. Don't fall into those pitfalls again. One of the other things that I was going to mention was there's also an opposite psychological effect that happens during complacency is that you get really, a lot of people all of a sudden start to worry. It's like, oh my God, the market's been going up and up and up and up and up. It's going to crash. This is it. This is going to be it. This is going to be the month it's going to crash. I don't even want to trade. So all of a sudden you have that opposite effect where people are too scared to do anything and become paralyzed to do anything. and they don't trade at all. And one of the things about income trading and trading these types of income trades where you're making, trying to make a living and doing it like a business, is that you want to put on trades when they give you the right opportunity to do that. So you're looking for the right opportunity to get in, but they tend to be very on a cycle, like maybe every monthly cycle or every weekly cycle or whatever type of trade it is that you tend to do them on, or every so many days to expiration. So consistency is really important with these high probability trades. That's what keeps the overall graph, the equity graph, continuing hopefully on an upward swing, is that they are high probability, but you don't have any idea of when those losses are going to come. Most of the time, these are going to be winners, 80% plus winners. Which ones are going to be the losers? You don't know when you get into a trade. You're not 100% sure. I mean, there are times where you might want to skip a trade because it just isn't giving you the best bang for your buck, or there's really some crazy stuff going on in the market that's so crazy and out of whack that you just want to wait for things to settle down. But for the most part, these types of trades, all of these income types of trades, high probability, they tend to work best if you're consistent with them and just do them every month or every cycle of whatever it is, whether it's weekly or monthly or every 2 months or whatever it is, and just keep doing them. And over time, everything's going to kind of smooth out. I really like, I think that, Tom, you had a story about...
about Jim Cramer in his book. He talked about before he and his wife got married, they were both traders at this company, and he was in a position that was not very good and complaining about it, and he had to go to the bathroom, so he left, and his future ex-wife walked over to his terminal, closed the trade he was in, and when he came back, she said, "Oh, I closed that trade you were in," and he got really mad at her. She's like, "Well, if you like it so much, then why don't you just put it back on?" He said, "I wouldn't put that dog on," and then she said, "Well, why are you still in it then?" So the lesson is that every day you decide that this trade that you're in is the best place for your capital. So if you have that option that's expiring in 2 days or tomorrow and you're going to squeeze another 10 cents out of it, is that the kind of trade you would put on if you were all in cash? Would you put that trade on? So that's always a good question that I ask myself. Do I want to stay in this trade? Is this the best use of the margin I've got?
Yeah. Yeah, exactly. I ask myself that all the time. And actually, that's interesting. I'm just looking through some of the comments in the chat, and Rick, he's one of my subscribers. He had told me this earlier. For the August expiration month, for those of you guys not in my service, for the August expiration month, it was a phenomenal month. It was things where it was just, one of those perfect setups. As far as you couldn't, have a more perfect setup to get into a trade. We had a huge vol pop, and I got into the trade right at the top, basically, of this really big volatility pop. And then immediately afterwards, it completely evaporated. So, of course, being, taking in credit, all of that volatility coming out, made the trade profitable. Like within a week, it had quite a bit of profit already in it. So I was able to close that trade out really early with about, I think it was over a 7% profit on the August expiration trade. And I like to make, like 3.5%, 4% each month on average. And, of course, sometimes I get more than that, like 5, maybe 6, but 7 is really nice. So it hit 7%. I took it off, and I still had, a couple weeks before I had to put on the next trade. So there was kind of like, there might be an opportunity to put on another one. I chose not to, but Rick was one of the students that chose, he found like, one little pop down in the day, decided to put on a second weirdo, and he mentions it here. He put it on his second weirdo for August after closing the first one early, which we did, and he says he's already up 2% on the new one, so he's double dipping, which is great. So sometimes, so there's a perfect example. At that particular time, I can just show this like towards the end of that trade. I'm just going to go into the end of that trade, and you'll see what I mean. Let's go to, I'm not sharing my screen. That's not really helpful, is it? Share my desktop real quick. Yeah. Share my desktop. You guys can see my desktop?
Yep.
All right, let's clear out this model trade. Let's go to, all right. So, I don't know what trade that is. Let's go live today. Okay, that's the existing one right now. So let's get out of that. Let's go back to the August one. And I'll show you something. Kind of hits home to this. So let's see. Whoops. Go back August. I think I started on the 8th. It was out on the 22nd. So let's go to, well, I'll just go to the 22nd, then I'll go backwards a little bit from there. So it was already off on that day. So here's like the day before I'm going to exit the trade, right? And as you can see here, I think it was like the next, I can't remember exactly what time it's. There we go. So here's the day that I actually exited the trade. You know, it's right in the sweet spot of the T plus 0 line. So I've got wiggle room to the downside and the upside to not really lose anything. You know, volatility is going to start coming out of play with the, you know, actually it wouldn't start coming out of play because this collected so much theta so quickly. I take that back. Normally my target exit date is 14 days to expiration, which is still like 16 days away. Normally I'm not up in this range this close to after putting the trade on. I put it on the 8th, and this is the 22nd, right? So, but if you look at that, talking about, you know, would I, you know, what's the use of staying in this trade at this point? So here I am. My target exit date is 16 days away. As you can see, the T plus 0 line on that date, at least, it gets a little slanted, and there's really not much left to make. You know, maybe a couple $100 at the most if the market stays still where it's at, or moves down a little bit and doesn't have a huge volatility pop. But you know, there's not really enough to make, and it's already above my average. Why not just take it off? Because as what Rick did, it left him an opportunity, I think a couple days later, where he was able to enter into another one and then be up on that one and try to take a profit on that. He found another opportunity to get into another weirder trade for the same monthly cycle. But you know, and that was, you know, based on what he thought was, you know, good risk reward for what he was looking for. So, so you know, it at least opens you up for an option to be able to do something else with your margin, whether it's the same trade in the same monthly cycle, the same trade in another cycle, for, you know, waiting for a good opportunity to pop up, you have that margin available, or it's you know, a completely different trade, or maybe you want to take a little vacation or something until the next cycle presents itself, an opportunity presents itself. So you know, it's a perfect example of you know, getting out early so that you have an opportunity to use your margin for something else. So that was a quick little thing there. So let's see if there's any questions. Back here to the thing. Oh boy, I don't know if these are questions or just comments. Is there anything else you wanted to add, Tom? Or
Kevin asked, do you trade any positive delta trades to reduce your negative delta exposure for your total portfolio?
Positive delta to reduce the negative delta for the total portfolio. This particular trade, my nested condor and my weirdo trade are my two main trades that I do, and most of that percentage goes towards the weirdo, especially for this environment right now. The nested one, I don't really even look at the Greeks. It's more of, I just deal with the probabilities on that one. The weirdo kind of fluctuates back and forth between positive and negative delta, but it's kept mostly neutral. I try to keep it more neutral. Just the trade itself is more of a neutral delta trade. So I don't need an additional trade to keep a positive delta to keep that delta in check. It's the adjustments that I make to that trade that kind of keep it pretty much delta neutral. So I hope that answers your question. So I don't have a specific positive delta trade. I might do something positive delta to make within the trade to make it more neutral if it gets out of hand, Greek-wise.
We had another one that Eli had asked, how much of the losses can the put mitigate if there's a significant correction? Have you looked at that?
Well, just one put by itself, or the put, I guess, I do a combination of put debit spreads and puts. The debit spreads, if most of mine are like 20-point wide, so the most it's going to mitigate is, the most it can make is, 20 points minus whatever you paid for it. So what I try to do with my weird ores, I try to keep it delta neutral, and if it starts to get in trouble, I take care of it before it's going to become a problem.
But I think he's talking about
multiple. I'm sorry?
Yeah, I think he's talking about like a black swan event. Say the market opens down 20%.
Well, I do have extra, like what you call them, teenies. And they're different for my portfolio margin account. I use the weeklies. In my Reg T accounts, I just use the same monthly cycle. But in case of a black swan event, they tend to, volatility. So let's just take a look at this. They tend to, well, this is kind of the end of the trade, but let's go look at the, see the line here. So they tend to, if this dropped off a cliff, and you can see this T plus 0 line, it does drop quite a bit. But if I increase my volatility...
Oh, you need to share your screen, I think.
Oh, shoot. I keep turning it off. I apologize.
No problem.
There we go. Back?
There we go.
Okay. So let's say there was a black swan event or something, and I can't do anything. I do have some, out-of-the-money puts, and I do, differently depending on the account, like it's a Reg T or a portfolio margin, but I always do have those in place so that if there is something like that that happens, volatility is going to go through the roof. And you can see, let's say volatility, you can see this line pops up because the protection that I have on, the volatility in that is going to help. Whereas my put credit spreads, of course, are going to be in trouble, but they'll some of that will be mitigated by the volatility, a big IV pop going up and helping the the puts that I have as debit spreads and just individual puts, so it won't be as painful if something like that happens. Of course, it's not going to be great, but it does help. There's always a trade-off, though. If you put too much of that kind of stuff on, you want to do enough to where you're not blowing up your account, but you don't want to do too much to where you're not going to make any money in the trade. So that's, but that definitely does help. And as you can see there, if I add, if I start with the here I am here, you can see like with a big vol pop, let's say 3 points, that line pops up over here. So I think if you go even further out, you can see, it actually becomes positive. Of course, you don't want to be...
Get 20% corrections, you actually be making money.
Exactly. So in a black swan event, they really do help because you're only going to, with the credit spreads, you're only going to lose a maximum amount. With the put debit spreads, you're only going to make a maximum amount, but with the additional puts, they're there to help you in a black swan event. You want them there. I want them there. So it kind of helps out both ways. So hopefully that answers that question.
Kevin said he had another question, but he said, never mind, you just answered it. So I think that's the end of the questions.
Oh, okay. Great. I think there was other questions. Are you sure? Let's see. Delta tree. Okay, I answered that. What percent?
What percent of your portfolio do you put on a weird or each month?
I usually put about 50%.
And then Edward asked, what about trading a positive Vega trade in your overall portfolio?
I do not have one now. I think it would be a good idea, especially in this environment. And I'm looking at adding something like that. I've never actually had a positive vega trade that I've really come up with that works well for me yet. But it's not, I basically have been sticking with my high probability stuff. And I've gone through some pretty crazy markets with them too. So the weirdo I haven't been trading as long as the condors, but going through 2008, 2009, 2010, the flash crash in 2010, and then everything that happened before that, still, made some really decent money, even without having the positive vega trades. They definitely help when you go from a low volatility environment to a higher one, and we are certainly in that right now. So it would help to have something that takes out some of that vega. The weird ore is definitely not as short vega as the condors, but it is still short vega. So it would be nice to have something that helps that. But overall, I think even in a change in a big vol pop, I still seem to be able to manage those to where I keep the losses small and the winners keep coming. So and timing is a lot to do with this too. It's like sometimes there could be a huge event that happens, but because of the timing of when I got into the trade or where it is at that particular moment in time, it might not have a big effect. I guess you can call that luck, but I try to design, when I'm doing my adjustments and what I'm doing with it, so that I can deal with any situation, whether it's going from low to high, or the opposite obviously is more helpful. I can't say that every single month is going to be a winner, but I have a certain expectation of most of the time the winners are going to outperform the losers, and just trying to keep it small, keep the losers as small as possible. So even with the down moves, I've been able to do that when that's happened on this particular trade. So hopefully that answers your question. But I'd like to have a positive vega trade in this environment. I think it would be a good thing. And it'd be good to it's good to have more than one thing that might offset each other too, where you have a bad month in one, you have a good month in the other. That would be nice. Is there any other questions out there? Kevin's asking, let's see. Is it one delta put that you buy? Does he mean like just a one, like the number one? Ashgar is asking me. No, it's actually high. I don't put them out that far. I put them far enough away, but usually I think they're around a 3 or a 4 delta. I don't put them out so far that they're that they only have value maybe that first week. They should have value through the life of when I want to be in the trade. Okay, do you trade stocks, or do you option trades or just do option trades for your portfolio? I used to trade, I only do option trades. I used to do a lot more options and stocks when I was first starting out, as along with the indexes. I don't do them as much anymore. I did do Apple for about a year or two for a while, and that was, worked out really well, but it was just cash secured puts. It wasn't any fancy option strategies. I used to do double diagonals on Goldman Sachs years ago, and that worked out for quite a while. The only thing a couple things I don't like about trading options and stocks, or just stocks in general, is one, that you have to keep up with the particular stock itself and its earning cycles and different things that are going on with that particular company. So there's a lot more to kind of keep, on top of, as well as certain things that might be happening in the industry that it's at. So even though the stock or the company might be doing one thing, the industry has a hit and it affects that stock as well. And then the other thing is tax benefits are a lot, you have much more benefit tax-wise with index options, or indexes in general, and futures for that matter, than you do with stocks. With stocks, unless you hold that option on the stock or the stock itself for a year or longer, you're going to be stuck paying ordinary income taxes with our short-term capital gains, which is a much higher tax rate. Whereas with index options, you're trading, you can keep something for a day, it doesn't matter. You're still only 60% of that is going to be capped at the long-term capital gains rate, and only 40% is going to be of your gains are going to be taxed at the ordinary income or the long-term capital gains rate. So that's a couple of reasons why I don't do stocks. Rick is saying, in a highly volatile market, I will add more trailing puts with a rising market if I can get them dirt cheap and they don't screw up my Greeks. And there's still a few weeks left in the trade. That's a good idea. You know, you want to buy them when they're cheap if you can. So if the market starts going up and you can get them cheaper, then it protects you if we reverse. Absolutely. Let's see. Kevin says Hillary wants to change that 2 or 3 years for cap gains. Yeah. I'm not looking forward to. Well, I'm just. Whatever. It is what it is. I'm hoping that it'll still be beneficial, so we'll see what happens. And keep my fingers crossed that it'll still be a beneficial way to trade. But, you know, either way, it's still a good way to make a living. So, and
well, and if you change it in the U.S., there are countries that don't tax trading income like Belgium.
Oh, how do they do that there?
There is no tax on trading income in Belgium.
Oh, really? Oh, okay.
So that's an option.
Yeah. Is that where all of your trading accounts are, Tom?
No, unfortunately, I'm a U.S. citizen, and we have to pay tax on our worldwide income. But there are other countries that don't do that. So if you're making a living from trading, you do have alternatives if the tax situation gets out of control.
That's cool. Good to know.
All right, well, looks like we're right at an hour, so
okay.
Thanks, Amy. It's been a nice chat and to go over some good topics that we should all remember as we go through our trades.
Oh, no problem. I enjoy coming on and doing these things, and hopefully, I know, you know, it's probably rehashing the same stuff that we all know, but I just thought it was a good subject considering, you know, where we've been in the market for the last couple of years, and possibly, you know, who knows what we have in store. But, you know, from this low volatile environment, there could be some choppiness on the way, maybe, maybe not. But it's good to remember those lessons if we go into that type of market. So.
Well, especially if you're a newer trader and haven't lived through them, you know, ask the older traders what lies ahead.
That's absolutely, yeah, exactly. And that, you know, that's the thing. I should have added that as a bullet point for people that are new, that have never seen volatile markets. That's going to be a pretty, you know, it's going to be scary when that happens. All of a sudden you're like, oh my God, I didn't even know it could do this. Now I know what it feels like, what people have been talking about. And that going through that, you definitely want to be prepared and, you know, take all the lessons that you've learned and stick with them, because those will help you. So, yeah, so that's it. So, cool. Thanks for having me on, and I'll do another one soon.
Okay, great. We appreciate you, Amy, all that you do, and good trading to everyone, and we will see you next time.
Yep. Thanks, everybody. Bye.